Hello and welcome to this video, which is related to Portfolio Manager's distribution module. In this video, I'm going to take you through Chapter 6, which relates to collective investment vehicle. As the learning objective itself says, this particular chapter has four types of collective investment vehicles that we are going to discuss. They are mutual fund, real estate investment trust, infrastructure investment trust, and alternative investment fund. Out of these, I'm sure you have already heard and read about mutual fund and maybe others also. So, mutual fund is a type of collective investment vehicle. Now, what is the meaning of the word collective investment vehicle? It simply means that it's a investment tool which collects money or pools money from various investors and then invest them as per a predefined objective. Okay, so you can see the same thing here. So this is the definition that you can see, and let me just highlight this to help you understand that a mutual fund is a professionally managed investment vehicle that pools money from multiple investors to invest in a diversified portfolio of securities such as stocks, bonds, money market instruments, and other assets, right? So this is what is mutual fund doing, right? So this mutual fund will be using this money through their experienced fund managers who will make investment decisions based on fund's objective, risk profile, and prevailing market condition. These are the important thing that you should know when you are preparing for the exam, right? So mutual fund allows investors to participate in capital market without the need to have the direct stock picking expertise. So that's where mutual fund helps you, because if you do not have stock picking ability, then you can rely on a mutual fund, and mutual fund demonstrates the value of its investment through what is called as NAV or net asset value, right? So mutual funds, obviously they are not just focused on one type of investment. Okay, mutual funds will cater to different investment goals: wealth creation, income generation, and capital preservation. So there may be a question in exam: which of the following is not done by mutual fund, right? And you may have a fourth option. So if you focus on these points, this will help you to prepare for the exam. What is the role of the mutual fund? So mutual funds have many types of roles that they perform. Okay, mutual funds basically help build wealth, manage risk, and achieve financial goals. So if you are an investor, you may depend or rely upon mutual fund for these purposes. Correct. Now let me take you to what are the key benefits that mutual funds bring. So they help in diversification and risk reduction. The core of mutual fund is that do not put all your eggs in one basket. So it's a very diversified investment. Professional fund manager means you have the experts who will be managing the funds for you. Accessibility and affordability, which means you can start this investments with very small amount also. You don't need really big amount, correct? There is liquidity and flexibility. Liquidity means that whenever you want to exit from a mutual fund, you will be able to exit from it easily, and you also have the flexibility. Okay, flexibility in the sense that you can decide to invest as per your choice, as per the timings and all that, right? It is tax efficient. Okay, so tax efficient means there are options such as ELSS, right? Equity linked savings scheme, right? So mutual funds offer tax benefit schemes also. This is an important point to note, right, from the exams perspective. And they have variety of options: equity fund, debt fund, and all that, right? So these variety of options are also very relevant for the investors. They are transparent uh, because they are using investors' money. They have to do multiple disclosures, right? And they are also regulated by SEBI. And last point, which is very relevant, is economies of scale. So when you operate at a large level, you have economies of scale. The cost is less because with the same resource you can manage more funds, right? So large scale investments allow fund managers to negotiate better deal on securities, reducing cost per investor. That is the point that I was trying to highlight even earlier. So these are some of the things that you need to know about mutual fund, and your questions around will be around features of mutual fund, benefits of mutual fund, how they help investors. The points that I've highlighted, you can revise those points. Now the second is the real estate investment trust. Right now, this is mutual fund is also a trust structure. Those of you who know mutual fund know that mutual funds are not companies; they are trust, created as trust. So real estate investment trust is also a trust. The only difference is that they pool funds from multiple investors to invest in commercial real estate such as offices, malls, warehouses, hotels, which will generate income. So the asset class here has changed. In case of mutual fund, the asset class was shares, bonds, certificate of deposit, and all that. Here the asset class is real estate. Okay. SEBI regulates REITs in India. So you should know there could be a question in the exam which will ask who regulates REITs in India, right? Again, they bring the same kind of benefit, diversification and accessibility, stable income. They generate income from rental yields, right? So rental yield and dividend distribution. So this is a very important point that you should know. Okay, REITs also can be traded on stock exchange. That is one additional benefit that they bring. While the underlying cannot be traded, REIT can be traded. They are regulated by SEBI, and it is said that real estate typically appreciates because of limited availability of land and the residential premises which are there. So this helps in protecting against the inflation. Right now, we have infrastructure investment trust. So real estate investment trust was more focused on real estate. Now, infrastructure investment trust, as the name suggests, is focused on infrastructure. Okay, so they pool money from investors to invest in infrastructure, right? So these are the infrastructures in which they are investing, right? Now, in a country like India, where infrastructure is growing really fast and a lot of investment is being made, right? These investment trusts make sense for the investors. What else? They provide a structured way for developers to monetize infrastructure assets while offering investors a stable source of income. That is what is being done by these funds. So, this is also a very relevant point to note as to how these funds are helping the investors. Okay. Now they are regulated by SEBI. They are again trust. Okay. They can be listed on stock exchange, or rather must be listed on stock exchange, ensuring transparency and liquidity. So again, they give you stable, income. Look at the source of income that they have. This is very important. Huh? So mutual funds make money from increase in the share price. REITs from the rental yield and dividend. And here you get from toll collection, electricity tariff, and other infrastructure revenue. Okay, they are diversified. They have liquidity, a lower risk and regulation, and inflation hedge. Again, the same logic, almost the same logic that we had in case of what is called as the real estate investment trust. Now, the fourth type, which we saw in the beginning, is AIFs, alternative investment funds. So, the name itself suggests that they don't invest in traditional assets and they invest in non traditional assets. And these are some of the non traditional assets in which these funds are investing. Which are them? You have private equity, venture capital, hedge fund, real estate, distressed assets, and structured debt. Now, remember, when you make a chart, you may make a chart and see what is the structure. So, structure is trust. Where do they invest? You make a chart. How do they generate income? What about liquidity? What about regulation? So, you can have all these parameters, and then you can easily understand from exam perspective how to, you know, mm, uh, understand these concepts and get good marks in exam. AIFs typically are targeted a high net worth individual. So this is not open for typically for retail investor, because they will ask you to invest a crore rupees, which you cannot easily do. But obviously, those who have money can do. Uh, and they help in diversification beyond traditional equity and debt market, right? They have high return potential. Because the risk that they take, or the investments that they make is like that. The professional management, structured risk management, okay, and customized investment strategy. One thing that we need to know is that mutual funds are one size fits all. So if you buy one scheme of a fund, it is same for everyone. But AIF is not like that. AIF is very customized. So there is a difference between AIF and mutual fund here that we need to know. What is the legal structure of all these entities? The point that I was telling you earlier. So mutual funds, you need to know these players. You should note down all these players. Sponsor, one who brings money. Trust and trustee company, who are responsible for holding the funds asset in fiduciary capacity. AMC will manage the fund. Custodian will hold the securities, and R&T agent, which is registrar and transfer agent, they handle investors' records, transactions, and fund unit administration. Similar thing will be there with REIT. They are also, they have also have a sponsor. They have a trust, REIT trust, investment manager, custodian, and valuer. Valuer is needed because unlike, okay, equity where you get the value from stock market, in case of REIT, it's not possible to get that value fairly. Of course, there is a market price which is available, but that may not be reliable because that is very very different and comes from different sources, right? So that's where this is important, that there should be a valuer in INVITs. They have a sponsor, trustee, investment manager, custodian, and valuer, and there is a project manager. Okay, so this project manager is responsible for operating and maintaining infrastructure. This is one key difference that you will come across. These structures ensure transparency, governance, and investor protection. Similarly, in case of AIFs, what you will see is that there is a sponsor, fund manager, trustee, and custodians, right? Now, what are the types of REITs that you will come across? So, equity mutual fund is a type of mutual fund within which you will have these types of funds. So, thematic, sectoral, ELSS, all these are, uh, types of equity mutual fund. You have debt funds, which invest in government securities, corporate bonds, short-term instruments, right? Hybrid funds, which will have a mix of the two, and passive funds, okay, exchange traded and other types of funds. Correct. We also have factor funds, okay, which are called as smart beta funds. So what they do is that they follow specific quantitative factors or characteristics such as value, momentum, volatility, etc., to construct the portfolio. So they're slightly different from what we discussed. And stock selection is done on the basis of mathematical rules optimizing the desired output. Factor funds provide a rule based and systematic approach to investing. This is very important because this chapter has introduced the concept of factor fund, so you must note this down. Correct. It enables investors to gain exposure to specific risk return drivers. Okay, and factor funds fall between active and passive funds. Okay, so they that's one very important point. They are neither active nor passive, they're somewhere between that. You can have momentum funds. Okay, these are the types of factor funds. uh, and what do they do? Momentum factor funds track stocks with strong upward price trends, aiming to capitalize on continuous momentum. These are the stocks which will keep on moving up, right? They have high risk also. Okay, and these funds, what do? They select the top performer and they do the rebalancing so that there is a risk mitigation. This is what they use for risk mitigation. Okay, now this strategy is effective in bull market and historically outperform benchmark market. So momentum fund will not obviously work in a bearish market. You have low volatility factor funds. As the name suggests, low volatility factor fund focus on stocks with lower price fluctuation, offering potentially better risk adjusted return over. So here you are not focusing on a very high volatile stock. You are actually focusing on a lower volatility stock. Then you have value funds, which will use various tools such as price to earning, price to book value, high dividend yield. Okay, and they actually are driven by investment philosophies which have been followed by the greats like Benjamin Graham and Warren Buffett, right? Then you have quality sector funds, which will focus on companies with strong fundamentals, and these funds perform well in bear markets, providing resilience during downturn. So these are very, very, very quality funds. Okay, so there could be funds which can also multiply or rather apply multiple strategies and do this. Correct. Then you have a REIT, which is equity REIT, own and manage commercial real properties. They are themselves owning and managing. Mortgage REIT, invest in real estate loans and mortgage-backed securities. Hybrid REIT, a mix of mortgage and equity. So these three things you must very clearly note down for the from the exam perspective, right? Then you have public InvITs, where they're listed on stock exchange, open to retail investors, provide liquidity. Private They are unlisted because the name itself suggests only available to institutional investors. Then we have full-fledged InvITs. They invest in operational and revenue generating assets, lower risk due to stable cash flows. And then we have development InvITs who are investing in under construction projects, right? So there is a higher risk here. Now, again, please note down the types of InvITs, which I have already shared here and which the book also shares, anyways. Then you have the AIFs. So they are category one. Okay, they invest in early stage businesses, social infrastructure, and social ventures and infrastructure funds. So these are the types. So sometimes in exam, what happens is you will be asked a question. Social venture funds are which type of AIF? So you should know, right? Similarly, category two has private equity, debt funds, funds of funds, and category 3 has hedge funds and quantitative funds. So please note that these classifications are important for you to remember from exam perspective, because there could be question which will say what type of fund is this and what category does it fall into. Fine. So you have sample questions which are anyway their answers, so I'm not taking you through. I hope you were able to understand the key aspects that you need to cover for exam following this video. Thank you for your valuable time.